What's been driving gold's recent rally to record highs, and what could potentially derail that uptrend? Here are three factors that have been driving the yellow metal to record highs. First, expectations of Fed rate cuts. As of early April, Fed funds futures priced a significant probability of further Fed rate cuts later in 2025. Lower rates typically make holding fiat currencies like the US dollar less attractive relative to hard assets like gold. If the Fed cuts as much or more than expected, this could fuel gold's rally. However, if the Federal Reserve stays on hold or were to actually hike rates rather than cutting, this could potentially derail gold's upward trend. Second, inflation expectations. U.S. consumers and businesses are worried about the possibility of higher inflation in the U.S. The University of Michigan Consumer Confidence Survey showed that inflation expectations over the next 5 to 10 years have risen to a 33-year high in March. Moreover, the prices paid components of the ISM Manufacturing and Services Business Surveys show that American companies are facing increasing cost pressures. Higher cost pressures plus the possibility of lower central bank rates could fuel inflation expectations further. And when people expect higher inflation, they often look to real assets like gold for protection. And they're not alone, which brings us to the third reason, central bank buying. The world's central banks have been increasing their holdings of gold ever since 2008. This tells us two things. First, that central banks see gold as a currency and not a commodity. And secondly, that central banks would prefer to hold gold rather than fiat currencies like the dollar or the euro amid rising geopolitical and trade uncertainty.